Hey guys, I'm Rich Bologna with Business Insider, and we're here live today with performance coach Tony Robbins. He's here to talk about his new book, Unshakeable, Your Financial Freedom Playbook, and to answer some of your questions. So if you have any personal finance or career questions for Tony, please leave them in the comments below. Tony, to start off, you had Money Master of the Game come out in 2014. It's a really big book, Unshakeable, kind of like a companion piece to this. Could you kind of tell us what this book is and why you wrote it?
Sure. First of all, I wrote Money Master of the Game because of 2008. I saw so many people losing their homes, losing half their net worth. I grew up dirt poor, so it wasn't a statistic to me, and I wanted to do something about it. But I thought the government would do something, and after 2 years, nothing had changed. So I've been coaching a man named Paul Tudor Jones, one of the top 10 financial traders in the world, for 24 years now. He hasn't lost money in 24 years, so he's extraordinary. And I've learned so much from him that I thought, you know, I've got access to the smartest financial people in the world. What if I interviewed 50 of the smartest people, found out whether the average investor can still win or not? Because quite frankly, 70% of trades every day are, high frequency trades. There's so much change in the market. We have negative interest rates. The world's a different place. So I wrote the book, became #1 bestseller for the New York Times, not because of me, but because it was the best of the best financial people on earth. But it was 674 pages, and I wanted to give people everything. So in the last 2 years, I've just seen so much fear expand. We see it in the political system with, the right and the left and President Trump. We see it certainly in economics. But what triggered me to write this book was I was actually interviewing former Fed Chief Alan Greenspan. He was the Fed Chief for 19 years under 4 presidents, the most powerful man in finance. And I spent 3 hours private with him, kind of digging in his brain. And then I had him on stage for a group I had for 2 hours. And we were talking about the fact that we're living in a world that's never existed. In 5,000 years of banking history, never did you give your money to the bank and pay them for it. They paid you for it, And so at the end of this, I said to him, the last question was, if you were put back ahead of the Fed today, what would you do? And the whole audience leaned in to hear, and I leaned in, and he kind of sat back for a moment, paused, thought, leaned in and said, I'd resign. So I thought, if the guy is going to resign, this is not encouraging. Then I interviewed Howard Marks of Oak Tree Capital. He manages $100 billion, if you can picture that. And this is a guy who in 2008, every week when the market was going down, he was spending $1 billion a week to buy stocks because they were so cheap. So he's really a smart man. And he was saying to me, Tony, if you're not confused by what's going on, you don't know what's going on. So that was the initial piece. I said, I want to write a short book that people could read in 3, 4, 5 hours over the weekend easily, but a playbook, something that would allow you to get from where you are today to where you really want to be financially. And it was the best information, but really streamlined, both on how to protect you. But the big focus was, we're in the 8th year now, just about, of this bull market. There's only one other bull market in history that's been longer. The average is every 5 years you get bear market. You get one every 5 years, and we've gone 8 years without a bear market. So a correction or a crash is coming. So I thought, I don't want people to go through what they went through in 2008. I hate writing books. I like them about as much as pulling out my eyelashes. It's just not my deal. I don't like to sit still for hours and doing this, but I said I gotta write it because the crash, I don't know if it's gonna come in 12 months, 24, 36, but it's coming. So I want to write a book that shows people how to protect themselves so they don't have any worries. And I also want to show them how to take advantage, because I don't think most viewers watching understand that if you're a millennial and you've got tons of debt from college and you're thinking, I'll never get out of it, you never will by earning, but you will by compounding. If you become an owner, if you become an investor, not just a person who's a consumer, if you own an Apple phone and you don't own Apple, and more importantly an Apple, let's say the S&P 500, a portion of it with some small amount of money, you're wasting away a good portion of your life. So, but people don't do it because they're afraid of losing. And how many people do you know that have been waiting, saying the market's overvalued for 8 years, and it's up 250% since 2009, right? So, and it's up 14% since President Trump became president in November, in less than 3 months. So while you're busy waiting, you could be becoming financially independent or free. And so for millennials or for baby boomers who never got started and think it's too late, I want them to know that the next crash is the greatest opportunity of your life, not just to protect yourself, but to leapfrog from where you are now to where you want to be. The opportunity will never be like that. The stock market is the only place that when it goes on sale, people get upset. If you love cars and I told you could get a Ferrari for 50% off, you'd be out of your mind. But if I tell you the stock market's 50% off, people are panicked. It is the opportunity to change your life financially. When you can buy Apple or Microsoft or Alphabet or whoever, you can buy some of the greatest companies for these massive 50, 60, 70% discounts. It will literally change your financial life. But most people won't be there because they're on the sidelines waiting for something to happen, waiting for the thing to clear up, waiting for it to crash. And by the way, if you're not going to invest now, when it crashes 30, 40, 50% or more, you're not going to suddenly have courage to jump in the market. So you got to get in it today, and maybe you can ask me some other questions because I'd like to give people some really cool, I'm a big believer that positive thinking is not it. Show me the facts. And if you understand the market, the purpose of this Unshakeable book, to make you unshakable doesn't mean you're just positive. It means that when everyone else is freaking out, you have your center. And because you have your center, you can make the right decisions and you can do things for yourself and your family that really make sense. But if you don't know that, you're always trying to time the market and it's a disaster. It'll never happen. So maybe we can touch on that as well.
Yeah, definitely. So you talked about two demographics for this book, whether it's millennials just starting out or maybe some older people who think it may be too late. Let's just start off with people at the beginning of their career. They don't have many, if any, assets. What do you say to them after having all of these conversations with these financial minds? What is the best advice for someone?
Well, I asked a gentleman from Princeton who is a very famous man who helped create index funds. He was a genius. He's a teacher there. His name's Burt Malkiel. And I asked him, I said, Burt, you've been around a long time. What's the biggest mistake that people are making today? And he said, Tony, it's that they do not tap into the power of compounded interest. We all know about it intellectually, but it is a force that'll make you wealthy. We see athletes. You see, for example, or entertainers, 50 Cent. 50 Cent has made more money than God. He made $100 million on vitamin water because he got a tip. I think his net worth was around $400 million, bankrupt. You look at the great athletes of the world or the great musicians. Johnny Depp right now, they're talking about he might have to go into bankruptcy. He's made $750 million, $750 million, but he spends $30,000 a month on wine. He spent $3 million to take Hunter Thompson and burn his body and shoot his ashes in a cannon into the sky. I mean, you can really mess yourself up. So what you really want to do is make money your slave instead of being the slave to money. You want to make money while you sleep. And anyone can do that if you tap into this. So compounding is like, I tell people that haven't begun the journey, your number one, first, most important financial decision of your life is to decide to become an owner of American businesses as opposed to just a consumer, as I just said. But the way you do that is you got to automate. You got to take a percentage of the money that you currently earn, and you got to make a hard decision that says that money is staying for me and my family forever. It's not going to Kate Spade. It's not going to Tesla. Other things can do that, but this 10, 15, 20% is staying in the family. And all you got to do is automate it so you don't see it. Because if you automate it, you'll adjust. Your mind will adjust, your body will adjust, your finances will adjust. And then if you build it into an account, then you figure out where to put it. And if you just had it in the market over 30 years has been up 10%. At that rate, you double your money every 7 years. The last 20 years, it's up 8%. You still, every 9 years, doubling your money. So people don't realize how powerful it is. I'll give you an example for a millennial like you're talking about. I give an example in the book of a 19-year-old kid that his dad convinces him to save $300 a month. It's a lot, but he does it from the beginning, so he gets used to it. And he does it from he's 19 to 28 years old, so basically 9 years. And in the total, he's put in, I think the number is $35,000. He never puts in another dime. He leaves it in the market, and let's pretend the market didn't do 10%. Pretend he only did 8%. At 8%, without another dime drop, he'll end up with $941,000 30 years later at retirement without putting another dime in. $35,000 to $1 million, right? Just that's the power of compounding. His best friend waits till he's 29 to start investing when the other guy quits, but he invests $300 every single month until he's 65. He puts in way more money, 5-6 times as much money. I think it's $180,000 if I remember correctly. The other guy's $35,000. He has less than $1 million because time is your friend. So it doesn't take a huge sum of money. It takes making that decision to codify. And if you feel like you can't save anything, no matter what, save 3.5%, 5%. Anyone can do that. And then make a promise go to your employer, or if it's your own business, set it up so that the next time you get a raise, or if it's your company, the next time you hit a certain number, 5% comes off the top and goes straight into your savings and investing account. And this was done by a behavioral economist who was nominated for a Nobel Prize. He calls it save more for tomorrow. Because we're all good at dieting tomorrow. We're all good at saving tomorrow. So he did a deal. You promise to save more tomorrow. You go to your employer and you set it up. And they did this with blue collar workers in the Midwest. And after 13 years, the average person was saving 15%. And the upper 30% were saving 20%. These people never saved anything in their life in investing. And why is that valuable? One of the examples I gave in my first book, and I brought it back in this one as well because it's so dramatic, was there's a man named Theodore Johnson. He worked for UPS in the 1950s. He never made more than $14,000 in his entire lifetime, and yet he retired with $70 million. You think that's impossible. And by the way, he gave away $35 million of it while he was still alive, which is pretty beautiful. And how he did it was a friend of his family came along and said to him, look, I'm going to make you a wealthy man. He goes, I'm never going to be wealthy. I make $14,000 a year. He goes, I'm going to make you a wealthy man. I'm going to put a 20% tax on all that you earn, and we're going to put this investment account, and it's going to grow, and it's going to make you wealthy. And Theodore said to him, I can't live on less than $14,000 a year, which everybody believes. He said, listen to me. If the IRS came and said, we added a 20% tax to you, you'd scream, you'd yell, you'd complain, you'd bitch, you'd whine, and you'd pay it. And you'd adjust to it. He goes, the difference is this is not going to government. This is going to make your future self wealthy. And he did it. So compounding, as basic as that is, everybody knows it. I always tell people knowledge is not power. Knowledge is potential power. Execution trumps knowledge every day of the week. Right now, after hearing this, go figure out 5%, 10%, 15%, whatever you're going to do, take a percentage, go to Schwab or somebody and automate it out of your paycheck and put an account. Even if you don't know where it goes yet, you could do that today. And then go pick up this book, please. I'm not making any money on it. Just like my last book, I'm donating 100% of the profits to this book to Feeding America. I fed 100 million people in 2015. I fed 100 million people in 2016. We're going to feed 100 million people this year through Feeding America again. This book will pay for about half that. So if you buy a book, you'll change your life and you'll feed 50 people. We're going to feed 1 billion people over the next 7 to 8 years, to give you an idea. So that's the first step. You got to get in the game. Then you got to come up with the right asset allocation, which we show you in this book. Like, you have to diversify. Can't put all of it in one place. We all know that. But how do you diversify so you have the least risk and the most upside? That's what we teach in Unshakeable.
Yeah, so Jamie is watching this, and she's in a position where she has that question, where to put her money. And I know that there's an introduction to the book from Jack Bogle, CEO of Vanguard. He talks about index funds. Is that something that you recommend for someone who doesn't really know what to invest in?
You don't want to put all your money even in index funds, because you don't want to put all let me clarify. Stocks, I interviewed a gentleman from Yale who won the Nobel Prize in economics. His name is Dr. Schiller. And he did something really beautiful that a lot of people hadn't done. He looked over the history of all asset classes, real estate, stocks, bonds, et cetera, and said, what are the returns in each century? And what he found out was that stocks provided obviously the highest rate of return for the last 2 centuries, but they're also the most volatile. So you can't put all your money in anything. You've got to diversify. But if you're going to choose between putting your money in a mutual fund, an actively managed mutual fund, which people do. Most people put their money, that's where 95% of people put their money. They go, my 401k, what mutual fund do I put it in? They don't know. They look for a 5-star mutual fund. None of those 5 stars stay 5 stars. Over a 10-year period of time, 248 5 stars, 4 are still a 5-star after that. Well, you want to find something that gives you breadth. And the problem with mutual funds is that if you put your money in mutual funds, they charge such high fees to figure out, what stocks they want to use. And 96% of the time, they fail to match the market. So only 4% actually ever match the market. Well, if you play blackjack and you get 2 face cards worth 20 and your inner idiot says, I think I'm going to get an ace, hit me, you have an 8% chance of getting an ace in that situation. You got a 4% chance of getting the right mutual fund. So index funds do not charge those fees. You get the breadth of the market, and they are absolutely one of the investments to have, but they're one. You don't want to put everything in anything, and we explain that in Unshakeable as well.
Angelica has a question in terms of exit strategies. When do you sell some of the stocks that you've invested in, or when do you know that it's time to kind of take your money out of the market?
Great question. Everyone has a different strategy or style on this. I have a partner named Peter Maluk who He has been named the #1 wealth manager by Barron's 3 years in a row, which no one's done in history. CNBC named him the #1 wealth manager 2 years in a row. This last year, Forbes came up with their own list. They made him #1. I'm on his board. I'm a partner in business. So if you do business with him, I want you to know I benefit. But he really guides people on how to build a plan. And his clients have been millionaires and billionaires, obviously. When I met him and decided to partner with him because he was doing such an amazing job, I said, I want the average American to be helped. So someone who's begun the journey. So I got him to build a new division where you can go to getasecondopinion.com, getasecondopinion.com, and his team will build, they'll either evaluate what you're already invested in, or they'll build you a plan for free. If you want to work with them, it's less than 1% to do it. If you want to do it yourself, you can do it as well. And I convinced him, though, to do that for people with as little as $50,000 or $100,000. So if you're early in the journey, you could still get someone to really coach you and show what's going on top of the book to give you an idea, to put together that ideal portfolio. Because again, one size not fit all. You don't want to put all your money in any one thing. Ray Dalio, who's the most successful hedge fund manager in the world, he's returned more money to investors than anybody in history. He has the largest hedge fund. A good-sized hedge fund is $15 billion. He's $165 billion, like 10 times bigger than anybody else. When I met him and talked with him, he taught me something simple. He said, Tony, people tend to invest in what they heard about, what they read about, or what their family did. Like if you were given stock when you were 10 years old, and hung on to it, you're a stock guy or girl. If your family, was broke and they bought a house and they fixed it up and sold it, and then they learned to do that again, you're a real estate person. But the problem is, every single asset class that you love will have a day where it drops 50 to 70% in a day. Dalio showed me this statistically on every asset you can look at. And he said, Tony, if it's later in life, you have no time to make up for it. So you have to diversify. And diversification is the only free lunch. It'll make that happen. But again, Peter will put a diversified plan together for people if they want to, get a second opinion from the #1 firm, and they can evaluate whether it makes sense or not for them.
We've had several people ask the question, even if they think that they've been doing things right in their career and with their money, sometimes something very unexpected happens, an illness, something with their job, tragedy, and then overnight their finances are drained. After talking to these investors, what do you find as ways to bounce back from something catastrophic like that?
Well, nobody wants to go through it, and we all do. And the one thing that money does not change is everyone's going to have some extreme stress in their life. We're going to lose family members. We're going to have a house catch on fire. You're going to get robbed. I mean, aren't you glad you showed up for this positive live Facebook? But it's true. So the difference in people is our ability to deal with those internal stresses, right? And so being unshakable doesn't mean that you're fearless. It means that you have fear, but you deal with it anyway. And I think, to address what they're really talking about here, I think what you really have to look at is, how do I set myself up to win even when I'm losing? And the first thing you got to do at the most basic level is you need to have 3 months, 6 months for some people, 12 months for some people. You want to build to have enough emergency cash that if you lost your job, if you lost everything, if you went through a medical emergency and so forth, you don't have to worry that you're going to fall off. So the first thing is really start to build that emergency fund for people, I think. Is one of the most important things. It's a simple thing. It's not an easy thing because it's hard to get yourself to just put some money aside that's not growing, but you need some that's available to you for those situations.
We've talked about young people a lot and just starting out investing. Michelle wants to know, say you're an older person, where do you start? Is it ever too late to start managing and saving your money? It's
so amazing. We're all living longer than we've ever lived. And the #1 fear of baby boomers, those old people you're talking about, I'm the last year of the baby boomers, so I understand. But their #1 fear is not dying. Dying is #2, but it's really low on the list by percentage-wise. The #1 is running out of money while they're alive. And so, to answer your question, I think what we really have to do is set ourselves up with a plan that will allow you to do well no matter what happens in the marketplace, so you're not fearful. So let me try and clarify. One of the chapters in the book is, a detective gets a fact and it informs them. But if you get a series of facts, a pattern of facts, it leads you to the truth. So let me give you a pattern of facts that might help your viewers and listeners a little bit. People don't invest because they're afraid of losing. They're afraid of losing because they see corrections or crashes or imagine them coming. What people need to know is that, so I'm being clear with you if you're watching, when the market drops 10 to 20% from the peak, it's called 10 to 20, it's called a correction. 20 and above, it's called a crash or a bear market. So I can talk in shorthand with you. So if you're listening now, how often should we be prepared for a correction? People freak out when the market corrects because they go, oh my God, is this going to lead to a crash and we'll lose all my money? The research shows that since 1900, for 116 years, we've averaged one correction a year every single year. So if you remember last January, the markets were imploding. It was the worst January in the history of the stock market. The market dropped. We lost $2.2 trillion in a few weeks. But we ended the year with a record-breaking performance. And you know what? That happens every year. The average correction lasts 56 days. So think of 2 months. It's kind of like, would you be surprised when winter comes? Well, financial winter comes every single year. And some people freak out and sell everything and take a loss. But the stock market has never taken a dime from anyone. Only you can do that to yourself by selling when you should be hanging on. Now, if you own one company, the company will be going under. But if you own the best companies in the world, let's say the S&P 500 is an example, then you've got diversification of the best companies. And as Warren Buffett said, for 2 centuries, American business and stock market has gone up. It has corrections, but the overall pattern is up because we're a productive society, the most in the world. We're in a situation where we have a growing population still, partly because of immigration. So the population, we have inflation and productivity. All those things make the markets go higher over the long term. So the corrections that you're so afraid of, if you sell then, you're like damaged goods. You never want to get in again. So what you want to do is recognize there's a correction every year. You should expect it and not freak out. And the average amount of the correction is 14%. So that might feel pretty uncomfortable. But if you study, as I'll show you in the book, every year you'll see pops back. Now, 80% of those corrections don't become a bear. They correct and come right back, 80% of them. 20% of the time it becomes a bear market or a crash, 20% or more. Now, they happen about every 5 years, that crash. That's why we're due for one. We've gone 8 years without one. So one's coming at some point in the relatively near future. You want to be prepared for it. But the average crash lasts a year. The average amount you loss is 33%, but it's not a loss unless you sell. And here's what you have to understand. Please hear me. I talk fast because I'm passionate trying to give you everything, but listen to me right now because if you hear this, I think I can get your full attention. If you understand that the crash is the greatest opportunity of your life to do well, and they're going to happen every 5 years, then all you have to be able to do is rebalance what you're doing, meaning let's say you had 60% in stocks and 40% in bonds, and the market crashes, and now your stocks are worth less. So your overall balance of your investments might be 40% stocks, 60% over here, because these are worth less. What Peter, my partner, did in 2008 that made money for his clients in mass, it's what grew him from $500 million to $23 billion in assets. That's how big he is now. Was he told people, the bear's coming. I don't know when. Here's what's going to happen. Here's how we're going to protect you so you're not going to lose a bunch of money. And this is how you're going to prosper. You're going to grow because of it. He grew that much with no advertising, no marketing, because all of his clients are making money. Their friends are losing money. They say, how are you doing it? And they gravitated towards him. So what you want to know about the bear market, though, that's the most important thing I want you to hear. Every bear market in the history of the United States for more than 2 centuries has led to a bull market. So you remember 2008, horrible time, market dropped 35, 40%, 50% from peak to trough for a brief time. It went up 69% in 2009, 2000, within 12 months of that. So, and I can show you every single one. So if you don't sell, if you do what Warren Buffett says and be greedy when people are fearful and be fearful when people are greedy, you would have kept your stocks, you would have lost the dime, and then when they shoot up, you have this unbelievable benefit. So the question I'm sure your viewers are having, saying, yeah, Tony, but isn't it too late to get in there now? The market's so high. Every day I hear about a new market high. Well, here's another statistic. On average, we have a new market high once a month. Sometimes there are a bunch of them in a row, but once a month. So when you hear that, it doesn't mean anything. Our population, our productivity, inflation is growing, so the market moves up. But the timing, here's what I want you to hear. This blew my mind when I found this statistic. I spoke at the JP Morgan Alternative Assets Total Investments Conference in Miami And you have to be a billionaire to get in. You have to prove you're a billionaire. 400 billionaires, pretty amazing group to speak to. And while I was there, I found this study. JP Morgan did a study, and so did Schwab, independently, 20-year study. And they found that over 20 years, the index, the S&P 500, if you invested in it, it gave you an 8.2% average return per year, which again means you're doubling your money about every 9 years. It's pretty amazing. But listen to me now. If you were out of the market just 10 of the best trading days in 20 years, your 8.2% was only 4.5, cut almost in half. If you missed the top 20 days, you made 2%. You might as well have had bonds with no risk. If you missed the top 30 days in 20 years, 1.5 days a year, and you missed those, that's all, you were just trying to time the market, you're out of the market, then you lost money. And if you say, well, okay, Tony, oh my God, then the most dangerous thing is being out of the market. That is correct. As long as you're unshakable and you don't overreact and sell, the overall pattern is clear. So that's all you got to do. Now, some people say, yeah, but what if I put my money in tomorrow and the market crashes and it's the worst day? Well, Schwab did a great study. They did a study where they said, okay, let's pick the worst day, let's pick the best day to invest in. Like you were a genius, you found the lowest market day of the entire year, you invested in that day. And then you take somebody else who's an idiot, not an idiot, unlucky we'll call them, they invested in the worst day. The market peaked and it crashed the next day. Third person is dollar cost averaging, meaning they just invest the same amount of money every month and the stocks are whatever price they are and that averages them out. Or the fourth person says, I'm not being this market, I'm going to hang on to my money so I have cash, and they keep it in cash. Well, the person who lost the most, the person in the hole, is the one in cash. They're 50% less than anybody else, including the person the worst day. The person who got on the best day got the best return. But after 20 years, the difference between the person who got on the best day and the person who got on the worst day was only $14,000. So the lesson is, get in the game. Stay in the game. Jack Bogle has been in the business 65 years, built Vanguard, $3 trillion company, right? $3 trillion of assets. He said, Tony, the secret is do nothing. Just stand there. He said, do nothing and stand there. Leave your money in the market. If you do anything, just add more to it, because over time, he's been in the business 65 years, you don't want to bet against American business. That's Warren Buffett, that's Jack Bogle, that's all the best investors on earth. And it's hard to do, but if you start to automate it and you do it regularly, oh my God, you will have financial freedom that most people never have. But more importantly, you won't just have peace of mind, you'll have inner strength. You'll know that you've mastered this area of your life, and it's not complex. Once you read this book, you can read it in 4 hours. As I said, it takes about 15 minutes a year. And if you want someone to coach you, we got people that coach you, but that's it. You go back to your life. I always tell people, if you got a job or if you own a company, no matter how confident you are in your company, technology changes, it can affect your business. Competition changes, it can affect your business. Society changes, it can affect your business. You need a second business on the side that has no employees, no moving parts, and takes 15 minutes a year. Your own separate money machine, your own investment little company. That's what everybody deserves to have. And you can get started today with the tiniest amount of money, but you got to educate yourself first. So take 4 hours. You can't afford, I'm telling you this, I make no money on the damn book. You can't afford to not read this book, because you're going to miss out on some of the greatest opportunities in your life if you don't. And again, 4 hours, you'll be through it. One weekend, you'll be through it.
We have time for one more question.
You got it.
It kind of goes beyond the investing, but it's from Lisa. She's wondering, okay, she's looking at her finances, but how do you talk about this with your partner, especially if they are not forthcoming about this? How do you get that dialogue started?
Well, if you try to tell your partner things and your partner loves you but doesn't think this is your expertise, and for most people it's not their expertise, you're much better off to educate yourself and then share your learnings. Don't say, let's do this. Just say, gosh, look at this. I just learned this thing. There's so many things in this book that make you look cool at dinner, because you know things nobody knows. Even the 1% very often doesn't know some of these things. But you'd educate your partner, and then the fear starts to disappear. But at Creative Planning, we require the very first meeting, if you have a spouse, that they're there. And the reason is because we want to find out their goals, your goals, and we want to help you guys put this together. And it's hard to do that on your own. It's kind of like hard to do surgery on yourself. You know, you're a brain surgeon, you're really brilliant. You don't want to do it to yourself. So having an outsider kind of guide you through that is extremely helpful.
And then with this conversation about the fiduciary rule.
Oh, I'm so glad you brought that up before they go. I got to mention that.
Yeah.
If you're watching right now, there's a new word you got to learn. It's an F word, fiduciary. It's a mouthful. Here's what it means. The biggest challenge today is that the financial industry is focused on making profits for their shareholders, which is what companies are supposed to do. But in the financial industry, the only way they can make more money besides more clients is more fees. The only way you get more fees, usually without upsetting people, is to hide them. So you get these 35 to 50 page documents now that unless you got a PhD in finance, you'll never find the hidden fees. There's usually about 17 of them. If you're paying 3% in fees versus 1% in fees, it's the difference over 30 years of, you can own the same stocks, but if you pay 1% in fees, you got $762,000, you pay 3% in fees, you got $432,000. You want to go to a fiduciary. There's 310,000 financial professionals in the entire United States, 310,000. They got all kinds of names. The Wall Street Journal says there's 200 names for them. Wealth manager, wealth advisor, there's a zillion of them, financial advisor. But 90% of them are brokers. Now, there's nothing wrong with a broker. Brokers are good people, they work hard, but they work for the house. And if you know anything about the house, it always wins, right? They're selling products they might even believe in, but they've been sold, told, and trained to sell to you, and they aren't the best in those cases. They just aren't. Only 10% of all financial professionals are called fiduciaries, or another word for them is a registered investment advisor, or an RIA, registered investment advisor. So that means out of 310,000, there's 31,000, and they are legally required to put your needs ahead of their own, which should be every financial professional. If you live in Australia, if you live in England, everybody has a fiduciary standard. In America, because of lobbying, they can do something that's suitable. They can sell you something that makes them tons of money, but isn't that good for you, and they'll say, I think it's suitable for your goals. And there's no way to change that. If you go to an RIA and he tells you tomorrow, he says, first of all, I don't get paid, make any commissions as an RIA. I get paid like a dietitian. I don't sell you meat. Of course I'm going to sell you meat. I make money off it. I'm a dietitian. I say, stop the meat. You're going to get cancer. Let's do a little fish. Let's do a little salad. And you only pay for that, right? Those RIAs, those dietitians, get a flat fee or a percentage of your assets each year to work with you. They put the plan together, but they're not supposed to make commission. Unfortunately, I uncovered a gray part of the law. And out of the 31,000 people that are RIAs, literally 26,000 of them, so the vast majority, are what we call duly registered. That means they're a broker and they're an RIA. So if you got an RIA and he says, buy Apple, and you buy it, and then later in the day, he buys Apple for 20% less money, he has to give you his stock if he's an RIA. But if he's a broker, he doesn't have to. So the person says, I'm putting your best interest in front of you. I'm only here to serve you. But then in the middle of the conversation, he changes hats because he can legally do it and be a broker and sell you a product that he makes a big commission on that now hurts your return. So you want to find a fiduciary that is not duly registered. And I give you 7 questions in the book to ask anybody to know. But if you get somebody like that, they can guide you and they're not going to screw you over. But you still need a fiduciary that's also talented. So that's why you need somebody that's dealt with a bear market before and done it successfully. And that's the reason that I partnered with Peter.
Great. Well, thank you so much, Tony, and thank you for watching.
Thank you, guys. Nice meeting you all.